Well, our next guest says 2023 turned out to be a much better year than most investors had anticipated, just mentioning those gains on U.S. markets there. And in terms of a recession, well, it seems unlikely to see one in the year ahead, he says. For more on the markets, let's hear from Alec Young. He's Chief Investment Strategist with MapSignals. Alec, thanks so much for joining us this afternoon.
Thanks for having me.
So, yeah, you're expecting 2024 to be another strong year for equities. How much does that depend on a soft landing in the U.S.?
Well, clearly the economy dodging a significant recession is probably the biggest pillar of our bullish call. It's also the biggest risk to markets in the U.S. In the year ahead. But we continue to think that the soft landing scenario that's playing out is going to continue. Ultimately, the U.S. job market is proving pretty resilient, and our economy is driven about 70% by consumer spending. So it's just hard to see a recession taking hold, especially a severe recession when the labor market is continuing to hold up very well. And on top of that, inflation is continuing to move down, and that's giving the Fed scope to not only stop raising interest rates, but eventually beginning to cut rates, which is generally stimulative for the economic outlook. So we think if we were going to have a nasty economic outcome, we would have had it by now. A lot of the forecasters that were expecting recession have been calling for that for about 2 years now. So we think now that we've been through the tightening cycle from the Fed, and we're actually on the verge of much more accommodative monetary policy, the economy is going to continue to hold up better than a lot of people think.
In your outlook for 2024, Alec, you try to tackle what you're calling a couple of popular bear tales. And first one you mentioned was higher treasury yields make stocks less attractive. So break that down for us and tell us why you don't think that's the case this time around.
Well, there's a couple of aspects to that. The first is that the equity risk premium, so the earnings yield of the S&P 500, the profits of the companies in the index divided by the index, it's about 5.25%. The 10-year treasury yield is around 4.25%. So the spread is called the equity risk premium. It's about 1%. Over the long term, it's averaged about 3%. So a big part of the bear case is that this narrow equity risk premium sort of shows that stocks are less attractive when compared to bonds. We would just point out that the low equity risk premium is just a function of how much rates have moved up this year in the U.S. and the fact that corporate earnings were down year over year in the first half. But now that rates have normalized, they're coming down a little bit. The interest rate outlook is stabilizing, and corporate profits are actually reaccelerating. And year-over-year earnings growth is running at about 6% on the S&P, and it's expected to be up in the low double digits next year. We think those things are really what investors should be focusing on, not the fact that the equity risk premium is a little narrower than the historical average. The other thing to note about the whole stock bond conversation is that cash yields are likely peaking as we speak. So the 5% that investors can earn in short-term treasuries is probably not going to get any better moving forward as we get closer and closer to Fed easing, which the market's currently expecting in May. But needless to say, that your days are numbered in terms of being able to earn 5% on your cash. The other thing to keep in mind is that 5% only works out to 3 to 3.5% after taxes, depending on your tax bracket. And inflation in the U.S., the CPI is currently running about 3.2% year over year. We'll get an update on that tomorrow morning. But right now, these short-term treasuries that everyone seems to love so much are barely keeping you ahead of inflation, number one. And number two, the yields are likely to come down as the Fed begins easing monetary policy in 2024.
So you're expecting to see a fairly big move out of the likes of, money market funds and what have you and into equities in 2024?
Yeah, we've got currently a record amount of cash in money markets, CDs, short-term treasuries, $5.7 trillion. So the total U.S. stock market's worth about $50 trillion. So if about half the money that's sitting in cash decides to move into stocks as yields on money markets come down as the Fed cuts rates, that would be about 5-6% of the total value of the U.S. stock market, moving in to the market. And so that we think would be quite positive. So we kind of view these record cash levels in an environment where yields are about to start to drop as actually very positive for the stock market.
What about where we've seen a lot of the strength this year in some of those big tech names? How do you see that going into next year? Because, I read that you said that you think that that's bullish and not bearish. So tell us a bit about why.
Sure. Well, most people interpret the relatively narrow stock market leadership of 2023 in the U.S. as being a negative harbinger. The fact that, the Magnificent Seven big mega cap tech stocks have driven a large percentage of the gains. The bears argue that's a negative. We actually view it as a positive. Historically, if you look at narrow market rallies and what happens in the next 12 months, the stock market does better when after periods of narrow leadership than it does after periods of broad leadership, because there's still plenty of stocks left to play catch up versus a rally that's been very broad where everything's run up. There's fewer horses to keep the wagon going, so to speak. Whereas right now, there's plenty of areas like small caps, value stocks. There's most of the U.S. stock market is up more like mid-single digits this year versus 20% plus for the big tech stocks. So we actually view this as positive for 2024, not negative.